Hello, Gowinvest family. Today we're talking about Bollinger Bands in our 101 class. Gowinvest 101, your one-stop shop to learn everything to do with investing and trading. Um, my name is Sobi Kenobi, and without any further ado, let's start with the class. Okay, so let's start with lesson 4. Go up here, lesson 4, which is the Bollinger Bands. This is a data scientist's most favorite technical indicator, and the reason being is because it uses traditional statistic techniques. Imagine you had a whole bunch of students, all of them different sizes, different ages, and what you want to do is you want to build a graph of height versus age. So you take a sample. You can't take all the people in the world. It's going to be, if you wanted to do this graph and you want to say that I want to generalize it to everybody in the world, you won't have that. That would be a population mean and a population standard deviation. Standard deviation. And in this case, you only have a sample standard deviation and you have a sample mean. So this is called a sample mean. This is your sample deviation. It's an S versus a sigma. And so you start plotting. You get this guy's age, you get his height, you plot it over there. You get this person's age and height, and then you plot it over there. And you plot it over here, you plot it over here, you plot it over here, here, and you've got an average line that moves like this. Okay, so what you want to see is like you'll probably get some other points that are randomly scattered around here, and the way to find out what standard deviation would be like how far away do these points tend to move away from that mean? That is the meaning of standard deviation. So you want to give a kind of representation that can show you the variance, or basically what standard deviation is the square root of the variance. Variance means how far can it move, from the distance of the average. So let's say something that was pretty narrow, points right close by to the line, will have a mean and it'll have a very small standard deviation. Whereas points that have points way far from the mean is gonna have a lot bigger of a standard deviation. That aside, well, the way to calculate it is to get these residuals, the closest valley from, or the closest distance from each of these points to the line. And basically, this is a residuals plot. And you get each of these ones, and you basically do the mean minus the point squared, and you sum up the means minus point squared. This gives you the sum of squares, and you divide it by n plus 1 or something like that. I don't know if it's n minus 1, n plus 1, something of the matter. This gives you what is known as the standard deviation, um, or you might have to square root it. I'm not exactly sure. There is a calculation for standard deviations. For normal purposes, you just use that as your metric. So everything in the world by Bayes calculation is follows this type of a normal type of graph. It's not necessarily, well, normal is a specific configuration of this type of graph, but you have tailing ends, you have a mean, your mean is right here, okay, and 68, I believe, or 60, I'm guessing it's 68% of the data falls within one standard deviation. And then 98% falls within two standard deviations. So that's the whole idea, is basically instead of you just doing a moving average over the data, how about you model those data points in that window as normal distribution. Normal distribution. And you go 2 out in the standard deviation, so that'll give you a 98 percentile chance that it should be within this range of the mean. So on the graph, you have this mean indicator that'll kind of track it really well. And then you'll have an upper bound and a lower bound. This being two standard deviations from the top, which is here, and this is two standard deviations from the bottom, which is there. So it gives this type of ghastly overlay to the stock value, to the charts, and we'll see that over here. You can see this like upper bounds and lower bounds with this chart. You can see it go on the 15-minute, you can see it on the 10-minute, see it on the 5-minute charts, and even the 1 minute if you want to. But basically what it does is it gives you a good idea of uptrends and downtrends. So you can see over here, this whole period of fall, it was trailing below the midline. So it would always hit the midline, trail below it, and you can see this live as it's being traded. So as soon as volatility is short, like say here, there's not a lot of volatility. It kind of converges. But as soon as a thing like this, it's a huge drop, the volatility spikes. And you can see that even though it's hitting the bottom of the Bollinger Band, even the upper band goes up a little bit because there's a chance that these points could also shoot up by high volatility. So this maps volatility to some extent. And what you generally like to see is things that follow well within the upper bands and lower bands. So if this goes on the upper band and it hits the mid and jumps on only the upper band, it's an upwards trend. If this is below the middle band, always hits the middle band and still falls, that's a downwards trend. Here's an upwards trend. Here's what is kind of a downwards trend, but it's not for that long. Here's another huge upwards trend. Then a little bit of a downwards trend. Whenever you see this constrict, you can say that this is a time of inflection potentially, um, and so forth. So how would you trade this? So saying I look right after a downturn, generally you'll see a full downturn occurring, okay? And you think it's pretty low. The RSI and everything is looking pretty low. Let's bring up those indicators. It's out, well, the RSI, the MACD indicators looking pretty low over here. Let's zoom in. We can see right here, it's the end of a downward trend. Okay, and right here you see that the RSI has hit pure bottom right here, at the 30, kind of going up from there. The MACD is just done a quadruple down on MACD. It could potentially indicate a rise. Right here, we've had a period of where it wouldn't hit the mid of the Bollinger Bands. So what happens is Bollinger Band on the way up, and then it went down for a little bit, and then it went up again. And now it's hitting the upper bands of the Bollinger Band. So this is a very bullish indicator. It's saying that right now we've gone through a period of downtrend, now starts the rise. So you can invest here on the time that it hit the Bollinger Band. It may look like it's falling below the Bollinger Band, but again, you see that the volatility squeezes. And if the volatility squeezes, you're still in good territory whether it teeters up and down against the Bollinger Band. Then right here, you have a clear uptrend. It goes up, 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 and then right here it goes down below the Bollinger Band again, so it's already done its uptick. Now it's going below the Bollinger Band and it hits the bottom. And hitting the bottom, the reason why we didn't care for it here is because our volatility squeezed. But over here, when our volatility is high and then it hits the bottom, generally means that it's gonna like we're gonna wait for it to kind of go up again to see if it continues on the high, and maybe this was just a fluke. But if it doesn't go above the midline and hits below the midline, at that point it's time to sell. So right here you could kind of get an assessment of this is where you would have sold. Generally, this is where you would have bought. So you have about like almost a 30-50 cent increase from here to there. Okay, 50 cent increase from about these 2 points. And similarly, you can do that if you're going to go with the short position, is that this one through a high uptrend. MACD is high, RSI is pretty high. It's due for a downtrend, goes down, hits on lower Bollinger Band, tries to come up but goes down again. Time to buy in. Look for the next reversal here. It kind of goes above Bollinger Band, couldn't hold it, goes back down, but then it goes back up and it hits the upper. So right here, you would have bought in the second one on the downswing, and then you would have probably sold right here, as soon as it hits upper. Not too much of a gain per se, but this is on the 1 minute chart. So if you were to do this on a greater level chart, you could see the swing lasts a lot longer. One way down, one way up. And then you'd have to kind of ride these inner waves as well. So more chance for profits if you look up a wider lane, and less chance for profits if you're looking at the smaller section, but definitely more safer if you're looking up a smaller section versus a larger section. That's my 2 minutes on it. Really, you have to check the volatility, compare it against your risk tolerance, and that's how you used to trade. Again, these are only trading generic stocks. We're not trading any options here. We're just trading stocks, and you can trail it pretty well. Now, if you wanted to do options, you have to kind of anticipate these things. There's a lot more to do with options that we're not ready for right now. We'll stick to stocks, and I do want to talk about some overall trading strategies with stocks, and then we'll move on to options basics. So that's the next video, is stock strategies, and I'll talk to you something about maybe the bigger picture, so some fundamental analysis, and stock strategies. So until then, thank you. and I hope you guys learned something.